Hi, Chris Duff over at Serious Land Capital Vacant Land Funding Partner. Continuing our mini Subdivide series here, primarily about minor subdivides, though there's a lot of carryover, just general flips, and we'll probably return to this topic many more times because it's really kind of an evolving field, and there's always various kind of individual characteristics associated with each type of subdivide deal. So I'm just trying to provide a lot more general guidelines at the moment. So we've already discussed general requirements, like what we'll look for in terms of spread for subdivide, as well as just deals in general, preferred diligence periods, what we like to see when presented with a deal. And now the next question that was asked is just our general funding requirements. So you can break that down a little bit further. It's obviously pretty general. We already spoke at length about probably the most important piece is the anticipated spread on the deal, where we look for roughly 2x conservative gross margin, incorporating all the anticipated value add or associated expenses with the deal, and still leaving that roughly 2x margin regardless of absolute value of the deal. And we also remarked in the previous episode about what we'd like to see when deals are presented to us. Again, generally the more info the better. But in terms of general funding requirements, so different funders will have in a sense of what most of us are looking for, I'd say, it's pretty typical, where a lot of funders will look for that roughly, 50 cents on the dollar type of property, some flexibility depending the particular area, and maybe the absolute dollar value. That's going to be fairly consistent. Various funders might have different caps or minimums associated with deals that they'll go after. Generally for us, we prefer, at the moment, roughly 50 to 500K in purchase price type deals, nothing below 20K purchase price. We can go higher than 500K. It's just generally in situations like that, given the capital requirements, if we can figure out how to get the seller to possibly finance the property, so it's less capital intensive, that's going to be more intriguing. If it's in transactional funding, we might be able to more routinely go higher because the capital turnover is going to be more significant. So we have some flexibility depending on the situation, but that's our kind of general paradigm that we'll operate within. And like I mentioned, some funders will be a bit more strict for deals that they might look at or not. I prefer the volume approach. Like, I'd rather look at far more deals and say no to more, but I want to make it easy to work with us as well. So while I did mention in the previous episode, hey, the more info you send, the better. It's going to make it easier and quicker for us to make a decision on it. We're going to favor you more as a land operator, but an absolute minimum, all we need is an APN and the state and the county, and again, ideally have a purchase agreement signed, or at least strong ongoing conversations with a seller for us to consider a deal further. So that should take 30 seconds to send over for us to initially start pricing out the property, which is absolutely bare minimum, because if you presented even less information, it wouldn't even be possible to find the property in the first place. So that's going to be our baseline requirement. Beyond that, and I know, again, some other funders, they might require, a couple opinions of values from brokers or full kind of due diligence sheet filled out and so forth. Personally, just think that that's a bit too restrictive to get people over the hurdle to reach out to us. So, personally, I prefer the volume approach, where we might get more slop sent our way, but we can kind of quickly filter that out. So that's the price to be paid for having an easier filter to reach out to us. Beyond that, we're national in focus here. Obviously, some states are going to be more active in terms of land deals. People ask, hey, what are hot counties? What are hot areas? It's such a grab bag, because you can have such ideal properties that might show up from a characteristic standpoint in a relatively slow market, and they might still be a better buy versus super active market where I have just a worse quality property. So it's not a one-to-one type comparison, but I usually tell people, take the lower 48 states, draw a U roughly from Washington State all the way up to maybe Virginia on the East Coast. Those are going to be your primary flipping states. There are some key ones in the middle, Colorado, Tennessee, Arkansas, come to mind. Some folks operate routinely in the upper Midwest, Minnesota and Wisconsin, Michigan, and we have as well, but it's just going to be a little less common. In terms of the thousands of deals that have been sent to us, there are definitely some states that we have not encountered yet. I actually don't think we've ever seen one from Hawaii. We have seen a couple Alaska ones. I don't think we've ever seen a Rhode Island come up. I'm really, there's most states are covered. I don't think we've seen maybe a South Dakota, those Great Plains states. Those are going to be pretty rare from a flipping perspective, but we've probably seen, 40 plus, maybe 45 of all the states in the country. Some of those might have only been once that we've ever seen, whereas some, we've seen hundreds of deals from, Texas and North Carolina and Tennessee, for instance. I mean, those are kind of old standbys from a land flipping perspective. But, that just serves as kind of a general guideline there. I know people ask that all the time, searching where are those best markets. And beyond that, we still try to keep a fairly open mind. So we don't necessarily have restrictions on size of the property. We'll look from, smaller infill lots to, major acreage, whether it's subdivide or just selling a parent parcel. We'll look at, possible entitlement deals as well. Some are going to be riskier on average. Like if something doesn't have legal access and there's not a kind of anticipated route or even, a good target for obtaining legal access, because maybe your pricing is just, so solid, and maybe the underlying asset outside of that access perspective makes it pretty interesting. Usually we're going to avoid ones like those, but if you're like, hey, I've already got a bead on this neighbor, we might be able to get an easement here, or can kind of work out an agreement, have enough margin in this deal that we could purchase and get it squared away, great. But generally, if we don't have legal access, I'm going to be pretty cautious about that. Same thing for physical access. I mean, you really need both to make it generally worthwhile. And very, very rarely, again, because our paradigm is we want at least like a 20K purchase price property. If something is truly landlocked, it's rare that you're going to have a property sell for more than that on the open market, unless somebody's really making a speculative investment. And that's usually not going to be our game plan or bet when we're considering an end buyer perspective. So that will be a tougher one for us to consider further when it comes to access. The other side is just, how nasty is the title situation? I know we've started to advertise and advocate that, hey, we can fund messy title deals, a la Logan Fulmer and Clint Turner has pursued this more frequently now. There's going to be certain thresholds for us to get involved. If you're trying to collect up undivided interest, how valuable is the underlying property? Are some of these deals going to be more likely where we initially get involved and can start throwing money at it? When you only have 10% of interest, but the remaining 90% is just, over one other owner or maybe a couple other owners, and the underlying asset's like really attractive. Maybe we do that versus something that's even a little bit more complex. And, we might want you to reach a threshold of at least, 50% of, undivided interest before we consider getting involved with a messy title deal. And how many other avenues still need to be cleaned up. Do you need to find some co-owner that's totally off the grid? How easy are these people to potentially get in touch with? That's going to change the situation as well. So if title is pretty difficult, we might consider bailing on pursuing the property further as well. And again, for subdivides, I know I could have mentioned this in the previous podcast, but understanding what the child parcel outlay might look like. If you already have it diagrammed out, we might disagree with it. We might try to reframe it, understanding, is there potential adverse selection risk for some of these child parcels versus not? That's going to be another consideration of ours that might affect our funding decision, or if we just consider doing investment in the parent parcel if we think there's enough juice on an exit for the full. So that's kind of it from a requirements perspective. As you can see, like it's fairly loose there. Again, we try to cast a really wide net with only a few really key blockers that would prevent us from pursuing a property further. Oh, and generally, yeah, if there's like a high mortgage on the property, it's fine if there is, so long as you negotiate with the seller to have those costs taken out of their proceeds, or if not, the mortgage is low enough that we could still roughly 2x the margin on the deal. But if the mortgage is just, the outstanding mortgage is more than the anticipated purchase price is going to be for the property in full, or maybe you had delinquent taxes or owed HOA fees, are too pricey in relation to what we would value the property, roughly half of the conservative market value, it's not going to make it worth our while either. So that's probably it. Or maybe like a really complicated subdivide process, super long timeline, expensive to work with, higher risk for acceptance. That's going to be risky, like a rezone that doesn't have a lot of recent precedent. Those are also going to be other items that we might just say, hey, this is not really worth us pursuing. But again, I don't want to dissuade people, because we've explored all of these. It just depends on the underlying asset. If the underlying asset is good enough, it makes it far more likely that we'll get tied into extra levels of complexity that we might not otherwise do for less valuable properties. So with that, seriousland.capital for any of your funding needs, Land Daily Diligence Facebook group for review of your land deals at zero cost to you, and landpricer.ai for the most simple and accurate way to price land. Subscribe and share. Hopefully this Subdivide series has been helpful. Bye.